Since the beginning of 2024, markets are in an override mode with equity markets reaching new historic highs every month now, and price of gold looking almost like that Nvidia chart. All of this is probably a direct result of fiscal stimulation that essentially began October 2022 and intensified later in 2023. The price of gold has been sniffing monetary inflation all the way to the beginning of liquidity injections, and it really has picked up in pace in the last 5 months. What is the reason equities are rallying up so much and gold is going parabolic? Well, it has to do with fiscal dominance era that we have just entered recently, and it will probably define investing landscape for the next years. Gold is the wise and old market. There are two ways to perceive gold. You can perceive it as commodity or a currency. Gold is a commodity in a sense that it is used to produce jewelries, for example, or decorations, and for various industrial purposes, such as chips. Given the consumption of gold roughly equals to its new supply each year, let us assume it will have no strong effect on gold price. This allows us to perceive gold solely as currency. Now, currencies are competing with each other, and attractiveness of holding the currency is based on how much it can yield you and how safely does it store the value for you. Gold does not yield you anything, as it pays no interest as compared to paper money, for example, that yields you what the government is willing to pay you for buying its bonds, or banks for your savings account. From this point of view, gold is unattractive because it can't produce you any interest. Now, from storage point of view, there's little doubt that gold is the safest currency that exists on this planet. So if we assume gold as a currency, then the demand for gold is dependent on real interest yield of other currencies. Notice I say real because monetary inflation lowers your interest earned on a currency. So, for example, right now 10-year US Treasury yield is going to yield you around 4.4% per annum until its maturity. But it is not very informative to you because you must take into consideration how much the inflation has eroded your yield, right? So if prices of goods and services rose by, say, 3%, your 10-year bond is actually not that attractive as it yields you real interest of only 1.5%. Now, in this situation, it may seem better for some investors to hold gold, even though you can earn 1.5% on US dollars in real terms. The gold is much safer storage of wealth, so risk to reward ratio becomes unattractive for holding that fiat currency. So simply said, the gold can always sniff out monetary inflation. In other words, when money is being massively printed like in the last few years, or borrowed. That is why starting from October 2022, it has been in a bull market. As I said in my previous videos, October 2022 was the first red flag moment for the Western world that current financial markets cannot handle high interest rates. It was in this time when United Kingdom bond market almost collapsed due to intense sell-offs. This spooked, I believe, US fiscal and monetary authorities, which led to slowdown of liquidity drain, as you can see on the chart, via faster spending up of TGA, that's like a government wallet, spending money to stimulate the economy. But real trend reversal didn't come until March 2023, when regional banks in the United States began collapsing. See the red arrow on the chart. That moment was the last straw that led US authorities to abandon real quantitative tightening. Since then, liquidity drain from the system stopped and actually started increasing, meaning money was now flowing into the economy, providing additional stimulus. On one hand, I understand why they did what they did. The bank crisis, if it was unattended by the Fed and Treasury, would probably spark another 2008 huge financial crisis with spillover effects into the Europe, and true recession would commence. On the other hand, the trend reversal and liquidity injections have expansionary effects on the economy. Well, why is that problem? We want a strong and growing economy, right? Well, the problem is that inflation is still too high, and expanding the economy while trying to exhaust inflation honestly seems like a fool's errand. In the past, it would be unthinkable to increase interest rates and perform quantitative easing simultaneously, as those are polar opposites. But that is exactly what is happening nowadays. Some call this stealth QE because most analysts and investors don't know about this. And it is probably the reason why almost everyone on Wall Street was expecting a recession in 2023 and market crash, while the opposite happened, so they were all wrong. The thing is that almost nobody really understood back then how much money government is willing to funnel into the economy and how persistently they are going to do it. Now, gold senses all of this liquidity flowing into the economy, and it reacts with growth just like equities or cryptocurrencies. Now, most recent growth in gold price, I believe, is a direct result of Fed losing credibility in the eyes of investors. Notice that US inflation stopped decreasing in the last few months. It is actually holding its ground, almost looking like it's ready to start rising again with expanding economy. Last inflation reports in January and February were disastrous. The GDP growth in US is expected to be firm. Interestingly enough though, Fed decided to ignore this for now. On the last press conference on 20th of March, Fed's Jerome Powell literally said that in his opinion, financial conditions are not loose right now and that bad inflation data could be just seasonal bumps, therefore confirming that Fed still assumes 3 rate cuts this year. Really? Financial conditions are tight with equity markets rallying like there's no tomorrow? Here's the chart where in white line you have Goldman Sachs Financial Conditions Index charted against S&P 500. Really, since October, the financial conditions have been significantly loosening. Now, to be fair, financial conditions are also defined by performance of other assets and credit conditions, which are less optimistic. But everybody knows that equity markets have a very strong effect on economy, especially American economy. Most Americans, about 60% of adult population, own stocks, and if they see their wealth increasing the way they did in the last year and a half, that is sure as hell going to increase their spending and lead to higher inflation. Now, according to Goldman Sachs index, financial conditions are not currently as loose as they used to be during 2021 rally. But it is not going in the right direction if you want inflation to go down. So not only did Powell decide to ignore loose equity conditions, he decided to also not pay attention to higher inflation readings, and by being dovish, he further supported market rally repeatedly throughout the 2024, adding to the party. Now imagine this: the commodity prices bottoming, oil prices growing 20% year to date, goods prices disinflation stopping, stocks breaking new historic maximums, economy expanding, and Fed pumping the markets by the promise of lowering interest rates, which are effectively being pre-priced right now. Imagine all of this, and add inflation coming down to 2%. You tell me how probable is such outcome? Yeah, probably not very likely. And so markets started to understand that should this trajectory continue, inflation will not come down to 2%, and it may even start ticking back up again. Now, government bond yields under these conditions should normally start expanding with growing inflationary expectations, but I think they are being artificially held lower since really the pandemic outbreak by changing the composition of bond duration by US Treasury. It is a bit harder to explain, but simply put, for example, 10-year US Treasury yield, absent of all government interventions, should be right now over 5%, maybe 5 to 5.5%. This would sure as hell not permit the current rally on equity markets that we are witnessing and other risky assets. Instead, it is yielding about 4.4% right now, which significantly skews the market and is putting less restriction on financial conditions, which was purpose of all along, of course. Therefore, if expectations of inflation are growing, so should the bond yields, right? If you expect higher inflation, you will ask for higher compensation holding bonds. Actually, it is happening to a certain degree. 10-year Treasury yield is in a bull market since really the beginning of 2024, just as inflation index bond yields. Meaning markets do appreciate increasing uncertainty in relation to inflation. But in my opinion, this reaction is not as strong as it would be if markets were not manipulated. The price discovery process in the bond market is now unreliable. What they can't manipulate with, though, is gold market. They can print infinite amount of money by emitting various bonds, but what they really can't do is print gold. Therefore, right now, commodity markets are in some sense more reliable tool in analysis than US bond markets. I believe the recent parabolic move in gold is just a reflection of falling credibility of Federal Reserve System, as they refuse to efficiently fight inflation for whatever reason they might have. Some say it's because of elections in November, so they might be political. Others say it's because financial system is fragile, and with all those problems with regional banks and commercial real estate, the Fed tries not to pressure the system needlessly. Or you might choose to believe what they actually think, that this is just a seasonal occurrence and that everything will fall in its place in the next months. Whatever the reason, investor distrust is growing and so is gold price. In summary, gold is sniffing monetary inflation, and rightly so. Its growth signalizes growing skepticism of the markets towards the Fed. This could mean growing treasury yields in the weeks ahead, which will not be good for risky assets. Moreover, after last quarterly refunding announcement by the US government, it is obvious that US Treasury will accelerate its bond emissions as opposed to bills in second quarter, which is another force that could lead to higher yields. I perceive equity markets right now as being overly complacent and optimistic, so there's definitely some space for a pullback. I do not expect, however, that bear market will begin soon. I still think this pullback will end up in a rebound and markets will continue its bull market afterwards till the end of 2024. It's because I see that the US government perceives these upcoming elections as a very high-stake election, so I wouldn't expect them to just sit idle until elections, as they didn't do so far. Indeed, it may be that we have not seen the full extent of liquidity injections just yet.